Good afternoon, everyone. My name is John Franzreb. I'm an analyst here at AZZ Company. Our next presentation of the day is AZZ Inc., ticker AZZ. For those who are not familiar with the company, AZZ is a metal coatings company, largely serving the construction and other markets. We're fortunate to have with us here today Chief Marketing, Communications, and Investment Relations Officer, David Nark. He will do a presentation. Following the presentation, there'll be time for Q&A. Should you have a question, please enter it into the Q&A icon, and I will present it to David. With that said, thank you for being with us today. The floor is yours.
Thank you, John, and thanks everyone for joining us today. I appreciate your interest in AZZ, and I know that we have, very likely some current shareholders as well as maybe some folks that are new to the story, and maybe some that are revisiting it, and it's been a while. So, in any case, it's great to see all of you again here in the presentation. So, I'll get started. We'll get this moved along. Real quickly, just if you're not familiar with AZZ or you've been away from it for a while, just want to kind of give you a couple of high-level points that I'll be hitting today. We are a pure play metal coatings provider in North America. We are completely North American focused, with all locations now being in the US and a few in Canada. What you'll see throughout my presentation today, we've been accelerating sales growth, improving margins. We've got a lot of secular drivers behind us that I'll get through, and we generate a tremendous amount of free cash flow, which I think is something that we all like. As you look at the story, and I'll talk about capital allocation, you'll see we're doing not one or two things, but all things, and we think pretty well. We're looking strategically again at M&A, staying within the swim lanes of our two segments, while managing leverage, looking at how we return capital to shareholders through both share repurchases and dividends. We'll talk about that a bit. And then, I think all in all, when you put this all together, it just makes for a really compelling investment story. And I think that's been recognized through the share appreciation we've seen over the past few years, and more to come. So jumping into it real quickly, high-level snapshot on the business. You can see the sales and adjusted EBITDA represented by the two pie charts in the middle. Again, on a trailing 12, $1.62 billion in sales, $399 million in adjusted EBITDA, excluding corporate costs, and adjusted EBITDA margin of 24.7%. When you factor that in, corporate costs, which I've got a slide on that in a couple slides, it drops the margin down to 22%. So again, very strong even considering that. We are based in Fort Worth, Texas, about 3,700 employees across our 46 metal coatings and 14 coil coating locations. One of the things that, again, if you've been part of our story, you know all about the strategic transformation that we've underwent and have now completed over the past few years, moving away from a very disparate business of electrical, industrial, welding assets, as well as the metal coatings business, to, again, just a focused metal coatings company. That's really set us up well now, I think, as a focused business, really positioned well for growth and taking advantage of a lot of, again, tailwinds in the markets and strategic initiatives, as well as the focus on infrastructure build out and data centers where again, we're ideally positioned as well. Couple of things I think, again, this is just sort of a check the box reasons to believe the story today as you're tuning in. There was several things as we went through that strategic transformation that we said we were going to do, and those were identified here on the slide. Looking at the target leverage and debt reduction, we are now very comfortably at the low end of our range, our stated range of 1.5 to 2.5 times debt to EBITDA. We're sitting at 1.6 times debt to EBITDA at the end of our Q3. We are at the end of Q4 and have just started our new fiscal year. So we'll have more updates on this as we get into our financial earnings call, which is scheduled here in April on the 23rd. We'll have results out on the 22nd. Cash generation, again, you can see the results there. Very strong EBITDA, very strong EBITDA margins. And again, when we look at acquisition policies, for the past 3 years, we said we wouldn't do any acquisitions until we got the debt to EBITDA leverage down to a comfortable spot. Once we did complete an acquisition last year, about mid-year, of Canton Galvanizing. We do have a robust pipeline. We've got more opportunities in there, opportunistically looking at closing a couple of deals this year as well. Um, Dividends, we did increase the dividend about 17%, from 17 cents to 20 cents last year. We are committed to taking a look at the dividend and increasing it commensurate with the growth in the business as we go forward from this point on. And then share repurchases, we do have a 10b5-1 plan in place that will automatically, buy in shares to offset dilution. Trailing 12-month share repurchases were 20 million in the past. Like I said, trailing 12. We do have a $100 million stock authorization that we just received from the board in the past quarter. That will be again in place to help fund that 10b5-1 plan that will offset, the equity comp grants and such. And then opportunistically, we will be buying in shares, when we see pullbacks as well. Quick look at end markets. You can see them on the slide here. Construction, 56% makes up our biggest end market. It's broken down into three sub-markets: infrastructure, construction, non-residential construction, and residential construction. And when you think about those three, each one represents about a third of that 56%. And then you can see the percentages on all the other end markets here as well. Couple of things that I would just point out on the right, things that we are very enthused about include the investment in infrastructure. We're definitely a late cycle business when you think about things like AIIJA and the infrastructure, spend. A lot of people were talking about that, a couple of years ago. We are now at that point where we're seeing the results of that as our customers are getting orders for, structural steel to be put in place, and they need it galvanized. Reshoring is certainly something in this environment that we're seeing and we're participating in with several manufacturing facilities either adding capacity or bringing capacity back online and working on projects. We'll talk a bit about the pre-painted steel and aluminum migration as I get further in the slides. Also, the conversion from plastics to aluminum. I've got some talking points on that I'll share with you as well. And also the conversion to coil coating. So all these things giving us a real positive view on the next fiscal year. I mentioned AIIJA again, just sort of a tip of the hat to AIIJA, and again what we're seeing related to that. So we're definitely seeing increased activity in roads, bridges, and projects. Certainly a lot of activity around power generation, and we included clean energy in here because we thought we would see a pull in and a start to a slowdown on solar projects, and we're seeing quite the opposite. We're seeing many of our customers talk about backlogs that are extending beyond the expiration of the tax credits for solar in particular. And that's really being driven by kind of that third bucket, the data center build out. Data center projects are now looking for co-located power. Several, power sources, including gas-fired turbines, are sold out for a number of years. So they're actually looking what else can they deploy to help with power generation needs, and they're kind of coming back to solar. So we're again opportunistic on all these things as we move forward. When you look at the business strategically, why metal coatings and why pre-coat and why are they together? I think a couple of things I would just point out to those, again, who are not familiar with the story. Well, we are a tolling business, which means that we don't have the commodity risks associated with steel or aluminum because we don't buy those. Our customers buy those. And then they bring that steel or aluminum to AZZ to get either galvanized or roll coated on the pre-coat side. So both businesses, tolling businesses, we understand it very well. Also, I would say that, because of that, we're a very service-driven culture, really focused on quality, really focused on customer service. We've invested in a number of tools to help us with that, which kind of leads me to the next slide. When we talk about technology, we really have two homegrown proprietary apps in our business today. One we call our digital galvanizing system, and for lack of a better word, it's the Domino's Pizza Tracker that we've built, and it's giving our customers, near real-time information on where their product is, if there's any delays or concerns, what those are. It allows us to take all the paper out of the process and move to a technology-based app. What you see on the picture there is an individual who's using a handheld scanner to measure the thickness of the zinc that we put on steel. This is a big technological advantage for us. We capture that information, which is what he's doing on that tablet right there that you see. And all that information is stored, so it helps us with quality, service, any kind of warranty issues. It also helps us share that information across our platform of plants so that everybody is producing the same quality product, and it helps us with zinc efficiencies. Coil Zone on the pre-coat side, very much a similar type of tool. A lot of integration with them. So they've got the tool seamlessly integrated through APIs and EDI with their customers. That allows those customers to place orders, pick a coil, get it painted, and then shipped out on a completely seamless process. And then finally, corporate, we're looking at IT infrastructure and AI. We've been very prudent in terms of AI. We're not doing AI for AI's sake, but rather making sure that we've got the policies set and the policies in place, and then starting to roll it out in a very pragmatic approach, starting with things like Microsoft Copilot and Teams, and giving our folks access to it in a very regimented format, and talking about the right ways and the wrong ways to make sure that we don't get into any issues. Quick little thing on R&D. We do have a longstanding partnership with Texas A&M. We've got several projects that we've worked on with them that have actually proven themselves out and that are in full deployment now and cascading across our plants. Most of those have to do with galvanizing, because we do have a small hot dip galvanizing kettle on site at Texas A&M. They can test various processes, and then if those pan out, we again implement those across the network. Sustainability, what I'll say is that, galvanizing itself is a very essential as well as environmentally friendly process. We're using zinc as the main input for galvanizing. And again, that's a mineral and something that, we take in vitamins. It exists in people today. So again, very environmentally friendly process. On sustainability initiatives, reports, and tracking, we have been really punching above our weight class, I think, on reporting and sustainability. We do have, if you go to azz.com, you can find our sustainability report. We've been reporting, scope 1, scope 2, scope 3 type emissions and initiatives for some time. And then from a people standpoint, when you look at diversity, again, the organization itself is a very diverse organization with slightly more than 50% of the population qualified as diverse. Quick look at the exec team. Again, a very experienced team here. We've got Tom and Jason as CEO, CFO. Brian, who's announced his retirement, will be replaced by Todd Bella. Also announced as the COO of Metal Coatings. Jeff's been in place for quite some time now for COO of Precoat Metals. And then you can see myself, Tara, Haley, and Roy, other folks in the management team. Collectively, all been together for quite some time here at AZZ. And the newest addition, I would say, overall to the organization was Jason, who came through us through the Precoat acquisition. But even then, he had 10+ years at Precoat prior to joining AZZ through the acquisition, and he's been here for another 4. So again, a tenured group that works really well together. Kind of quick look at corporate strategy, where we're heading. We put this out last year. We've got 3-year goals that we established. A couple of things there I would talk about. We want to grow organically, excluding M&A at 2x GDP. We think that that's very attainable, given what we're seeing in our end markets and in the business. We're going to be very focused, as I mentioned, on M&A targets. We're looking at a few things with respect to EBITDA, ROIC, and leverage. You can see them listed there. That kind of all goes into the blender and comes out as, a sales goal or target of, 2 billion plus by 2028 fiscal year, which would be next fiscal year for us because we just started FY 2027, and moving the margin profile up above the 22% EBITDA margin where we're at today. Again, includes the corporate costs. So the point here being that we want to grow the business and do that not at the sake of margin. So I think that's the kind of the key message we're trying to convey here. On acquisitions, again, I mentioned we do have a robust pipeline. We've talked about how we've got about 68 different opportunities that we've taken a look at. We've got 13 ish under evaluation. We've closed the one last year, and again, opportunistically looking forward to getting a couple of deals done this year as we've entered into our new fiscal year. Pipeline looks great. We're again very enthused about what we have and what we're working on, and hope to be able to communicate more about that in the coming months ahead. Real quick look at metal coatings, that segment. Again, this is a leading hot dip galvanizing business, 720 million trailing 12-month sales. What we do is we do not fabricate any steel. Our customers do, and then they bring it to us to have it galvanized. And again, you can see the individual here in the picture. That all the steel in the laydown yard here, that happens to be at our Crowley, Texas facility. You can see a number of monopoles, guardrails, a lot of infrastructure, parts pieces here in the laydown yard that have already been galvanized, getting ready to ship. And what he's doing is, again, taking that mil spec reading on every piece to make sure that we've got the right level of zinc applied to it. Market size, market share, you can see there about a $2.5 billion market. We've got 27% share. And again, a little chart there. It's gives you an idea of what the EBITDA performance has been in the business over the past 5 years since COVID. We'll kind of skip that, move on to, again, here's the footprint. I mentioned all the locations in North America. You can kind of see them here on the map. You can see our end markets as well for the segment. Construction's 28%, industrial's 20%, transportation's about 16%, electrical is 20%, and then other is just sort of a catch-all. So pretty evenly dispersed, amongst these 5 end markets here. And again, you can see some of the key technology that we have. We have hot dip galvanizing for large structures. We have spin galvanizing for small structures and parts pieces. We do powder coating and anodizing plating in some of our locations as well. This is a quick look at the financials of the business on the metal coating side. Again, you can see a very consistent growth on both sales and adjusted EBITDA, as well as the margin profile of the business there on the very bottom. Very strong margins for an industrial focused business. And, last but not least on metal coatings, before I jump into Precoat, again, some of the tailwinds here. I mentioned the reshoring, inorganic growth into white space on the M&A, and I'll talk a little bit more about that in a minute. And then, if we exhaust all those, we could potentially look at greenfield or brownfield plant expansions. We don't have any greenfield plant expansions currently in the budget for this fiscal year. But again, something that we will remain focused on if we don't see any opportunities through the M&A pipeline. All right, Precoat. Switching gears here a little bit to our other segment. Similar layout on the slide, kind of going left to right. 896 million in sales for the trailing 12. You can see the input is a little bit different. We're taking in steel and aluminum from our customers, running that through a continuous process, a very highly automated roll coating process. And again, a larger market size here, 4 billion and a slightly lower share, 23%. But again, a number one share position relative to our competitors. And in both cases, metal coatings and Precoat, we are the number one provider, and our nearest competitor is roughly half our size. Kind of jumping ahead again to the map, all the locations you'll see here again are sort of Texas and to the east. That's by design. Most of your locations in terms of metal processing, as well as the production of steel and aluminum, generally tend to be in these same places. So these plants generally tend to be located near steel mills, steel service centers, et cetera, or ports and waterways. That's a little bit different than our metal coatings business that tends to be located geographically more dispersed and nearby metal fabricators. On this slide, you can see the end markets as well on the top. Construction is a big one. It's again broken out in the sort of three categories. You have the ag market, then you have commercial, and then residential construction, sort of a third, represented by that 79%. Appliance and HVAC, container. We'll talk more about that in an upcoming slide, and then transportation, which is largely RVs and buses for us. Quick look at the financial performance for Precoat. Again, similar kind of growth trajectory that you saw for the metal coatings business over the past 5 years. One of the things that, as we think about the future and growing into the future, that we're pretty excited about is the Washington, Missouri plant that we completed last year on time, on budget. We do have a contracted run rate sales of 50 million or more for this fiscal year that we've just recently entered with a customer that we have a long-term contractual take-or-pay contract with. That take-or-pay contract is for 75% of the capacity for this plant. It's a long-term customer that we've been working with, not a new customer. They added additional aluminum manufacturing capacity at their facility. And so we made this investment to keep up with their growth. So pretty excited about it. Again, it should be adding 50 million incrementally this year as compared to last year, and at margins that are on the higher end of the range for metal or for Precoat Metals. Some strategic drivers for them, again, tailwinds include reshoring the plastics to aluminum. That's helping out in the beverage space. And again, you can see some of the other things that we're working on, getting folks focused on leveraging pre-painted steel in their manufacturing process as compared to painting it themselves. And then inorganically targeting some captive coil lines that are out there. These are old lines that are within customers' manufacturing processes today that operate at a rate of 1/4 the speed of ours, and we can go in and work with some of them very selectively and help them convert out of that line, and then leverage AZZ Precoat Metals, and then we get a long-term customer. So when you put those two together, what the business kind of looks like is this. Again, you get a very consistent top line growth, as well as a nice CAGR on the adjusted EBITDA line as well. One, I think, unique slide that we have in our deck that, not too many people have. We get the question a lot, so I included it is, how does the business perform, if there's a cycle and we start to see things, slow down. This is, emblematic of what we saw back in the big, cycle in '08, when we had the financial crisis. And you can see the metal coatings business in particular grew right through the cycle. Pre-coat metals had a little bit of a drop in 2009 and then a strong recovery the following year. We often get asked, why did metal coatings grow through the cycle? And again, the growth, although relatively nominal through '08 through calendar 10, is really driven by the fact that the business is focused on infrastructure. It has utility exposure to it, and those businesses generally tend to be very stable, even through cycles. Again, capital deployment, we'll kind of talk about that. On the left side of the slide here, you can kind of see where we were when we did the Precoat acquisition 4 years ago. It spiked our debt to EBITDA leverage up to 4.3 times. We have drastically reduced that to the 1.6 times, was where we were at the end of Q3. Again, a stated range of 1.5 to 2.5 times is where we'd like to operate the business. We have very strong free cash flow generation. We also have a $400 million revolver that's largely untapped. So, if those opportunities presented themselves, we can certainly, grow the business. We've got enough dry powder to do that through both, again, pulling on the revolver and then paying it down through the strong free cash flow of the business. Not looking to really spike it up above 3 times. We would have to do something, a deal that would be, in the neighborhood of an $800 million deal, or a collection of deals that would equal 800 million to get, over three times debt to EBITDA. So again, plenty of opportunity, plenty of dry powder without having to worry about debt to EBITDA. Kind of the focus of the year for capital allocation on the right, in no particular order. Strategic M&A, as I mentioned, we're looking at bolt-on acquisitions. We want to stay within our lane, do acquisitions in metal coatings and in pre-coat metals that make sense, where we can either fill in white space, collectively, maybe add to what we do today. So, for instance, look at that Canton acquisition that we did last year. That was largely for smaller structures. So it allowed us to, provide that service in that area where we already had a galvanizing facility, but it was more purpose-built for larger structures. So that allowed us to kind of expand our footprint and our presence there. High ROIC investments, again, we'll look at those in that context of M&A and as well as organic opportunities. We'll maintain the leverage rate, and again, returning capital to shareholders. We're going to do that through two ways. One is the very consistent dividend that we've provided to our customers since 1990. We've been a consistent dividend payer. And we will now begin to increase that as we increase the business and see the business perform better and better. And then, as I mentioned earlier, shareholders we'll do some shareholder or share repurchases and return capital to shareholders that way. I think when you look at AZZ, one of the questions I often get, and I'm sure John gets as well, is who to comp us against. Because we don't have very many, pure play direct competitors in the market, you really have to look at either coatings providers, building products, service centers, or steel mills. And when you kind of rack and stack those again, which is what we've done here for you, you can see that, our revenue growth, our EBITDA margin, and our net working capital to sales have really outperformed just about everybody else out there that you might compare us against. And that brings me to my final slide, and that's guidance. So, the guidance for the past year is listed here. FY 2026 is in our rearview mirror, and then 2027 guidance you can see listed here as well.
Okay. With that, let's do a quick Q&A, and I just want to get a quick point out, David, you mentioned that you don't really, you're a tolling company, but you do have a variable and relatively significant input cost in zinc.
Yep.
Zinc prices have been winding down this year. Increased supply, lower demand in China has been the primary drivers. Maybe you could just talk to the audience about the potential swings in zinc inputs and how that plays with your margins in your biggest business, most profitable business. I'm sorry.
Yeah, sure thing. So, yeah, as you mentioned, zinc is the number one cost component for our metal coatings business. I've been here now for almost 15 years. I've seen zinc swing from as low as, 80, we call it 80 cents, up to $2 at the start of the Russia-Ukraine war. Um, Zinc has been, operated within that range ever since then. We've seen a general, up until most recently, a general increase over the past year in the price of zinc. And we couple of things on kind of how we maintain that and can protect margins. So keep in mind it's a short cycle business. So we are quoting our customers, prices that are good for 30 days. And generally, what we'll do is we'll be giving somebody a quote, and we might quote it and galvanize it within the same week. So we have real good understanding of, the input costs as a result. Most of the zinc, to your point, John, that we purchase, we bought it 6 months ago, so we know what that cost was, and we use a FIFO accounting method to account for that. So it makes it very difficult for us, almost impossible to get really kind of behind the cost curve as a result. So we stay on top of it that way. We can adjust pricing. We don't have long-term contracts with customers. In the past, when we've seen a spike in zinc, we have put in a zinc surcharge so we can, stay ahead of it that way and keep on top of any inflationary expectations with zinc. And then similarly on the other side, when we see zinc prices come down, if we have a zinc surcharge in, we can take the zinc surcharge off. If there's not a zinc surcharge in and prices are coming off, we do our best to maintain the price, because we do have, other inflationary costs, with labor and other things. So most of the time, our customers aren't paying much attention, as we are to zinc. They're more concerned about turnaround times and quality than the price of zinc. So we don't get into too many, zinc specific questions with customers.
And I'm sure freight costs can be an issue sometime in the near future. But we are out of time. David, thank you for the expansive overview of the company. Looks like things are really, going in the right direction. Um, but we appreciate you being here at Sidoti and Company and hope you have a great balance of your day.
Great. Thanks, John. Take
Thanks,
care.
sir.
Thanks, everyone.
Bye now.